Welcome, everybody. I'm going to jump right into this discussion of COVID-19 and the reinvention of venture capital. So let me share some information first and also, set up what we're about to do. This is a discussion. It's an educational seminar, and I'm here with my colleague, Austin Meacham, and we'll walk you through some interesting research, some trends, some surveys, and some data from Valor's own portfolio. So let me get that kicked off by sharing a little bit of information, bringing up my screen share now. And what you're going to find is that toward the end of the presentation, we definitely want to hear from you. We want to get your thoughts and we want to get your perspective too. So please let me know if you have any trouble seeing the slide, and we'll move right in with some brief introductions. I'm Lisa Calhoun, like I said, founder and general partner at Valor Ventures. I also founded the nonprofit Startup Runway Foundation, which is the largest nonprofit pitch event in the country, introducing underrepresented founders to their first investor. I am proud to be in Kauffman Fellows Class 23, and before I founded this venture capital firm, I'm a serial operator. I'm also joined by my colleague, Austin Meacham, and I'll let him introduce himself.
Thank you, Lisa. As Lisa said, my name is Austin Meacham. I'm an associate for Valor Ventures, born and raised in New York. Go Knicks. I recently graduated from the Duke Fuqua School of Business with a Master of Management Studies in May of 2020. And I graduated from Dartmouth College in 2019.
So a little bit about the perspective behind some of this research, because always the person doing the curation has something, there's always some kind of inherent bias in that. So I wanted you to know a little bit more about our inherent bias. Our general partner has done over 50 deals, led over 50 deals in the Southeast region, primarily seed and in cities like Atlanta, Nashville, Athens, Alabama. So our perspective is really informed from those southern roots. And the Southeast is the only region in the US growing double digits. That's pre and post COVID. So that informs our thoughts as well. We're also the top region in the country for enterprise customers, with 28% of the Fortune 500 headquartered here in the Southeast. That's more than New York and California combined. So those types of backgrounds really inform some of the information that we selected that we thought would be of interest to you. And I'm going to jump right in to what we're actually seeing in COVID-19 during the pandemic itself. Now that we have a full quarter that was within the pandemic, we have some early intelligence back from our portfolio, which is led 70% by underrepresented founders. So our portfolio is privately held companies, and a lot of the financial data is, of course, sensitive. So I've presented more of a range of spectrum without numbers, but I'll tell you, it is very up and to the right. On the Y or vertical axis, you'll see the cost of doing business lower. COVID-19 is actually lowering the cost of business for a lot of software companies. And a lot of our portfolio has acknowledged that and moved into their cost of doing business is lowering or dramatically lower during COVID-19. And then what about revenue? On the x-axis, the horizontal axis, you see net revenue growth for the first half of 2020 compared to the first half of 2019. And they are really, by and large, the bulk of our portfolio has strong growing revenues. So again, there are no numbers on these charts, but I will tell you that these revenues are in the high double digits and triple digits, and that's how this map was put together. So real numbers for real companies. We're seeing a lot of tailwind thanks to COVID. And so we've developed a hypothesis around where the COVID-19 tailwinds are in venture capital. So let me step back and say a lot of VCs, and some very, very sharp ones, have said that this is an unknown space, that because of the pandemic, we can't possibly know what will happen. One of the VCs I greatly respect, Brad Feld, said a few months ago that anyone who was prognosticating about what's going to happen here, that they just don't know what they're talking about. And I think he's absolutely right. And at the same time, I think it's uncomfortably true that a fiduciary institutional investor has to develop a testable hypothesis about what will happen, because that's the only way to move forward in guiding your portfolio and your investment decisions. So these are some of the industries that we've identified as real beneficiaries of COVID-19, and they're broad. All things around remote work, and of course, tertiary things around remote work like security, securing your data, securing your people, their healthcare. Everything around remote work has been reopened and refreshed by COVID-19. So has architecture, designing safer spaces for dense populations. COVID has really highlighted that there are new ways to improve how we live and work together. Logistics, home as center. There's a lot of technologies to support that. On-demand healthcare and telemedicine, huge boost from COVID-19. Financial services, so that you can get the services you need without some of the high-touch protocols we currently have around debit cards and credit cards. Big opportunities. And of course, everyone's really aware of remote learning and the host of opportunities around childcare. So these industries are really being boosted. So I'm going to ask Austin to take us through some very interesting facts he's researched around what others are thinking around COVID-19.
Thank you, Lisa. So Industry Ventures has done a survey of 117 venture capital firms to get the impact of COVID-19 on the venture capital industry. And what they found was really interesting. Around 59% of respondents believe that COVID is going to be over and will return to a normalized environment in about 7 to 12 months. And though the vast majority, about 92% of respondents, are seeing headcount reductions in their portfolio companies, an equal amount, almost 93% of respondents, have reported their portfolio companies have at least 7 months of runway, with many of those firms saying that their companies have at least 13 to 24 months of runway. This is very encouraging. What this means is venture capital firms are confident that their portfolio companies will last throughout the duration of COVID-19. It's also important to note that only a quarter of investment firms believe that their investment pace is going to decrease during COVID-19. And this is really reflected in the numbers, as we can see from the next slide. So according to a study done by CB Insights, the amount of venture deals in Q2 of 2020 has actually increased from the amount of venture deals in Q1 of 2020, actually ending a 3-quarter decline. Now, what this means is, although the economy is struggling, and although some portfolio companies themselves are struggling, the appetite for venture deals and venture deal making has not decreased, and we can expect the pace of venture deals to continue. I'll now pass it back to Lisa.
Thanks, Austin. So I really liked this quote from Jason at Shasta Ventures. Shasta's another very seasoned venture capital firm. And back in April, Jason wrote that early stage companies that grow up in this new normal and adjust their businesses to post-pandemic are more likely to succeed. He really focused on that thought that the best companies are built in challenging times. And a lot of history shows that. I also really thought that this survey and insight from McKinsey really had a provocative thought that has really been encouraging to us, that 75% of people using digital channels for the first time indicate they're going to continue to use them when things return to normal. So the pandemic is pressurizing a lot of people's digital journeys. People that did not have to use software to extend themselves and their presence in the world are now using software because it's safer. And so what we're seeing is an expansion of opportunity for software, which is, of course, often venture-backed. Also, McKinsey pointed out, if China offers us any lesson, digital laggards are going to be substantially disadvantaged. So what does that mean for investors? One of the things that we find extremely compelling is that where native new startups are coming from is where the bulk of the action should be. And that is actually the Southeast. With 125 million people, the largest population of any region, we simply have, as a function of population, more startups. More startups than Silicon Valley, and more startups in the New York metro. And this is data drawn from Crunchbase from over a 10-year spread from some of our analysts' work previously, Rodney Morris and Cariana Morales. They also discovered that there's a complete imbalance in where the startups are getting funded. So look back to the Southeast, which is line 3, just about a quarter of startups who begin in the Southeast actually get funded in the Southeast. Whereas in Silicon Valley, the majority of startups that start there get funded there. And in New York, it is really locked and stacked. If you start a startup in New York, the chances are majority that you're going to get your funding there. So there's a serious disconnect between where the opportunity is being built by entrepreneurs and where the funding is. And of course, this is a tailwind to Valor because located in Atlanta, Georgia, with a portfolio that focuses on the Southeast, we're able to really pick from the cream of the crop. And what does that look like for investors in terms of the important things? Return on capital invested. Well, although there are fewer startups funded in the Southeast, their average multiple on invested capital for the investor is greater at 4.6 than the average multiple for invested capital for West Coast startups drawn from Crunchbase numbers. And so that brings up some very interesting opportunities that are pressurized by COVID-19. We want to invite you to our next research presentation, which is next Thursday. Rodney Morris and I will be talking through markups and multiples and dive more into the unique journey of Southeast versus West Coast startups. Really appreciate you turning to Valor for your research today, and thanks a lot for your time.